Gem International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views, which you can find online on cyclesman.com. Happy American Thanksgiving, Tim.
Thank you very much, Jim.
And I understand you're so into Thanksgiving, you've got 2 turkeys on the go.
2 turkeys on the go. I've got a turkey in the smoker, and I've got Cajun turkey in the oven, a stuffed Cajun turkey from the famous Rabidou's Meat Market in Iowa, Louisiana. Good stuff.
Yeah, my mouth is watering. Tim, gold has taken a pounding lately. Is this something you expected?
Absolutely. We have, if there's anything behaving normally, it's gold. At least according to my work, I have said, like I said all along, I think we talked about this in just almost every interview, that I did not think the 9-year cycle low had occurred in December, and that the rally out of that low should be counter trend, and that we should go down and test the December low and ideally violate it a little bit as we make the final push down into the 9-year cycle low later this year, early next. And that story has not changed. We continue to see the weakness in gold, and it's right on track.
So, in other words, after this dip, are you expecting a rapid rise?
Well, once we get into the 9-year cycle low, with this next intermediate and seasonal cycle low, as there nesting of cycles coming up, then I think that like I said, that's going to be the 9-year cycle low, and that's going to be a low of very high degree. It's going to be a low of the same degree that we saw back in 2000, 2001. It's going to be a low of the same degree we saw in October 2008, and gold is going to be set to rip. This would be the highest level in the history of gold in which a 9-year cycle low has occurred. And when I say the highest level, obviously the 2001-2 low, I think that low was like at 252, and the 2008 low occurred in the high 600 range. I think it was around 680, 81, if I remember right. And say this low, and I'm just throwing a number out there, but say this low occurs at 1,000 or 900 even. It's the highest level that we will have seen a 9-year cycle low, and I think this is potentially the 9-year low in the rally that the gold bugs have been looking for so long. It's certainly going to be set up for it. Yes.
Now, places like Russia are continuing to buy gold like crazy. Does this just give them an opportunity to snap up more at a lower price?
It is an opportunity for anybody as we move into, gold is kind of the opposite of equities. The gold bugs are anticipating and have been anticipating the bottom in gold while we've been anticipating and looking for the top in equities, and equities just keep going and gold just keeps going down. But gold makes total sense to me. People talk about manipulation in gold, but I see nothing there. It is on track, and anytime between now and, like I said, it's a nesting of cycles. We got to feel our way along as we get there. But later this year, to probably early next year, I'll say by the first quarter of next year, sometime during the first quarter of next year, no later than then, I expect that we will have the 9-year cycle low in place. And between now and then is a buying opportunity, but I think the buying opportunity is going to be better as we move into that time frame. In other words, I think it's going to get a little cheaper still.
And of course, people are wondering what's going to happen with the equity markets. Has President-elect Trump thrown a wrench into it?
he threw a little bit of a wrench into it. There's no question. You know, the rally coming out of the November 4th low or whatever that was. Yeah, November 4th, I think it was, going into, you know, the election. That was unusual. I say unusual. It wasn't expected. I knew that there was a trading and intermediate term cycle low coming due. I knew it was in the time frame of November, December. I really expected it to be in December with one more push down, and then we got this blast off rally here. And, you know, the can just keeps getting kicked down the road, as they say. Like I said, it's kind of the inverse of gold. From the perspective of everybody's looking for the low in gold, everybody's looking for the top in equities, and it's not coming. The thing with equities, look, structurally, the Dow theory non-confirmation stuff was blown out. The last time that we did the interview, I was a little bit taken off guard because I needed time to think about it, analyze it, and try to figure it out what it meant. I didn't have enough data to make a call on the fact that the Dow theory primary trend change had been negated as of that last interview. As I look at it here, it's more of the same. And what I mean is, look, it's like, how do I say this? It's like going to the doctor and getting an EKG, and you say, okay, I feel fine. The doctor says, yeah, but you got this heart condition. The EKG is not lying. It is what it is. It's scientific. It's based on evidence. It's based on probability. It's telling you something. And okay, you feel fine. That's great. But it doesn't change the underlying condition. And it's the same thing here with equities. I understand that this advance has been extended and stretched, and the more I dig, I have spent, there's no telling how many hours sitting at my desk trying to confirm this advance and going, what am I missing? I've looked at other people's work, like Norm Fosback, for one, does some high-low work way back in the day. I have these encyclopedias of technical analysis from way back, in the 60s and 70s. And I've dug through that material and trying to find answers and looking at charts, not only my work, but other people's work. And I'm like, trying to prove this advance. And I can't. The more I look, the more convincing the evidence is that it is an extended rally. It can't be trusted. It is an extension, and it is a massive bubble. But the fact that it keeps extending and stretching, I have no control over that. But the EKG is what it is. And for example, I'll give you just one of many. Peter Eliades, I was talking to him about it. He's an old-time technician. Many people listening may be aware of Peter and his work over the years. Great older technician. And Peter mentioned this Norm Fosback's work with new high, new low indicator, which is basically where the Hindenburg-Ullman evolved from. Well, anyway, he mentioned it, and I looked at just the very basics of Norm's work, and it basically is a measurement of new highs and new lows. I looked at that, and then one thing led to another. We did get a reading according to his work that said that this market's moving into that it's should be, or that it's, let me say this another way. It's an opportunity. Based on the reading, it's an untrustworthy move. It creates the opportunity for it to be a major top. So I'm looking for further confirmation of that, right? So I started looking at my own stuff and and derivatives of his work, and just, like I said, just literally digging for answers. And everything I find, like I said, just further confirms that it's an extension. One example, let me give you, getting long-winded and off track there. I took just a simple moving average, an intermediate term moving average of new highs. New highs, new lows. NYSE new highs minus new lows. And looked at it. And what I see is that as you come out of a 4-year cycle low, they expand. It makes sense. More new highs. It expands. As you move into the top, you start to get a breakdown, a divergence. Non-confirmation, if you will. And I see that with the 2000 top, the 98 4-year cycle top, the 2000 top, and further back. I'm just using these major tops. I see the non-confirmation with the 2007 top, and we began to see that same non-confirmation in 2015, which led to the July high and the break we saw into August, and then that additional decline into January, February. Well, guess what? Here we are at a new high again, and the divergence only continues. It's not expanding. It's not confirming the move like, say, coming out of a real 4-year bottom like in 2003, 2002, 2003, or how it expanded, in 2011 and 12. It's not there. The data's not there. It doesn't support the move. So I don't care how long the advance continues, it's not trustworthy. And what's going to happen here, I think, is we're going to see the setup reappear. We got some of the DNA markers in place. I think we're going to see probably what we have to look for is another Dow theory non-confirmation. I think we're going to see another Dow theory primary bearish trend change. And it's just a continuation of this equity bubble. And that's exactly what it is. The data does not support it.
Was it a big deal that the Dow Industrial topped 19,000?
The number means nothing to me. The level means nothing. It's about the structure. Of course, that's a hell of a move. There's no question about that. But as I also, let me say something else. Like I said, the number, that's totally irrelevant. It's the level. But in looking at this data and pouring through these charts, the one thing that jumps out, or the other thing that jumps out at me as well, is that the data all confirms that it is an extended 4-year cycle. There is nowhere I can possibly even force, based on historical norms, that we've seen a 4-year cycle low. So by default, what we're seeing is this enormous extension. And there is no question it has extended longer and gone further, and it just, it'll set up and, like I said, back in 2000, and it started trying to set up really in 2014. It didn't get a toehold till 2015, and then it rolled, like I said, into the lows last year in August, and then in earlier this year in January, February. And then since it's really gone nowhere, looking at the chart, until, we had to break out in August, and then we flatlined again, and then we have this, surge up, and so far it's flatlined again. And I'm not minimizing or trying to negate the advance. I'm saying basically in 2 years where, I don't know, I don't have the numbers in front of me, but in 2 years, yes, we've moved, it's up, 1,500 points or so. I'm just looking at a chart. I can't tell. But like I said, it's the underlying technical data that just doesn't support the move. So it's just telling me it's a continuation of the extension.
We'll have more with Tim Cyclesman Wood right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, President-elect Trump does not seem to be a big fan of quantitative easing. Does he believe that the markets should do what the markets do, react naturally?
From what I gather, that is his belief. It's my belief that, the market needs to be free. That's the problem that we have. And, whenever you start messing with the market, then you see weird things and things don't make sense, and you create bubbles, and like we have here. And the best thing they could do with the market in his administration is leave it alone. Let nature be nature and let it ebb and flow. I mean, everybody's heard of the business cycle, and there's ups and downs and ebbs and flows in the market and in any market. I mean, real estate market, the price of anything, there's natural ebbs and flows. And they have, you know, it's not conspiracy. I mean, you've been living under a rock to think otherwise. I mean, they have blatantly extended and manipulated this into the biggest bubble in history. And what the problem is, in turn, is that now you've got the biggest bubble in history, and you're like, holy crap, if I stop doing what I'm doing, it's going to implode. Yes, it's going to. This is a hell of a mess they've got us in. And some of the, you know, some of the stuff that, this is from the St. Louis Fed, I believe is where it is, but looking at some of the data, you know, student loans, the level of student loans, I saw some charts, and I'm saying this from memory, but I saw them, it's real, it's from the St. Louis Fed, and student loans are at record levels. Food stamp levels in the U.S., the recipients of food stamp, record levels. Federal debt, record levels. Money printing, record levels. Healthcare costs, off the chart. And at the same time, they also show that job participation rate that we have talked about so many times and tied to the velocity of money and the and the volume characteristics of this market and how this is really a bear market rally, even though it's at new highs. I know that is crazy sounding, but it all ties together. Anyway, I'm getting all off track again. But in addition to all those things off the chart, the other things off the chart in the opposite direction is the labor force participation rate. The workers' share of the economy is down. Median family income, according to the St. Louis Fed, looking at the chart, down. Home ownership, down. So the underlying economy continues to rot. And as I have said all along, the fact that they've held the market is not the economy. The market should be a byproduct of the economy. In other words, if the economy is healthy and money is changing hands and there's jobs and prosperity, then the market should be a byproduct of that. What we're seeing is just the opposite. The market, they've made it camouflage to try to cover the ugly. And now the economy hasn't recovered, and we're left with this bubble. I don't know. I don't know how long it can continue to last, but I'm telling you, the underlying technical data, in spite of the fact we're at a new high, it doesn't support it. And let me add one more thing. If you go back and if you think about it, this is kind of a crazy thought in a way. But I did the math, and I don't have it in front of me. But you know, every crash in history has happened from a new high. And I went back and I looked at it going back even into the 1900s, and I want to say like the decline, and don't hold me to it, don't send me an email because I'm saying this from fuzzy memory, but if you look at like in the decline from 1906, 1907, I want to say 30-40% decline, and from all-time new highs. If you look at the advance there in 19, I think it was 1919 or 1920 into the 1921 low, that was a massive decline of, again, I don't remember the numbers, call it 30% from new highs. Look at the advance into the 1929 high. Market was at all-time highs, dropped 89%, I believe the number was. In 1937, coming out of that bear market bottom, there was a big correction. Now, granted, in 37, it took the market, I think, 25, 26 years to get back above the 29 high. So in 37, we weren't above that high, but it was a good rally, and market appeared to be recovering, and then there was another healthy decline like that. If you look at the 1966, the bull market top where the 66.74 bear market began. Market was at an all-time new high. There was another big decline backing up, I think in 1960, I believe it was, pretty healthy decline. During the bear market rally into 1973, 72, 73, the market moved to a new high and then declined to a new low into the 74 low. It was at a new high is my point. 1987, where'd the crash come from? New highs. 2000, where'd it come from? New highs. 2007, new highs. My point is this. The fact that we're at a new high, everybody thinks everything's okay. And so, yes, on the one hand, again, I'm not denying the new high. Yes, it exists. But like I said, that EKG, it's still telling me the patient's sick. And so, the point is that while everybody thinks everything's okay with the new high, it's the point where everybody should be the most nervous.
Tim, have yourself a great Thanksgiving.
Jim, thank you very much. And I want to first of all say happy Thanksgiving to everyone, whether you're a U.S. citizen or not. Happy Thanksgiving. And I want to thank everybody for listening to us. And I guess I just want to also say, guys, I don't say these things to be contrary. I don't, it'd be much easier to just say, hey, the Dow's going to, 25,000, everything's great. But I can't say that. And I can't say it because I see what I see. And, I don't know. Like I said, I think that what we have to look for now is for the DNA markers to reappear, and we have some of them. We have seen some of them with this advance in November, and I think we're going to see the rest of them set up. This is a massive bubble, and it has gone on far further, longer than we have ever anticipated, but that doesn't change that it is what it is. And the last thing I'm going to do is get on here and tell you guys something that I don't see.
Tim, thanks again.
Thank you.
My guest has been Tim Cyclesman Wood, who has taken time out of his Thanksgiving preparations to talk to us here on HowStreet.com. You can find us on Twitter at TalkDigitalNet. You can forward your questions to info@HowStreet.com. I'm Jim Goddard. Happy American Thanksgiving.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.